Ever heard the saying, don't put all your eggs in one basket? In the world of investing, that's called diversification. It's about spreading your money across different types of investments, like stocks, bonds, and real estate. Think of it like this. If one investment takes a hit, the others can cushion the blow. This helps you sleep better at night, knowing your entire portfolio won't crumble if one sector stumbles. Diversification is your shield against the unexpected. It's about managing risk and protecting your hard-earned money. By spreading your investments, you're essentially betting on the overall market, not just one horse in the race. Remember, diversification is not about avoiding risk altogether, it's about managing it intelligently. It's the cornerstone of a sound investment strategy, whether you're just starting out or you're a seasoned investor. The stock market is a wild ride full of ups and downs. One day tech stocks are soaring, the next, they're plummeting. This volatility is where diversification comes in as your safety harness. Imagine putting all your money into a single company, only to see its stock price crash. Devastating, right? But with a diversified portfolio, the impact of one bad apple is minimized. Diversification works because different asset classes tend to perform differently under various market conditions. When one sector is down, another might be up, balancing out your overall returns. This doesn't mean you'll avoid losses altogether, but it does mean you're less likely to experience dramatic swings in your portfolio value. It's about smoothing out the ride and staying on track to reach your financial goals. Think of asset classes as the building blocks of your investment portfolio. Just like constructing a building, you need a strong foundation and a variety of materials to ensure stability and growth. Each asset class plays a unique role in your financial structure. Each block has its own characteristics, risks, and potential rewards. For instance, some assets might offer high returns, but come with significant risks, while others provide stability, but with lower returns. Understanding these nuances helps you make informed decisions. Understanding these differences is key to building a well-diversified portfolio. Diversification means spreading your investments across various asset classes to reduce risk. It's like not putting all your eggs in one basket. Stocks represent ownership in publicly traded companies. When you buy a stock, you become a part owner of that company. This ownership entitles you to a share of the company's profits, which can be paid out as dividends. They offer the potential for high growth, but also come with higher volatility. Stock prices can fluctuate widely in short periods, influenced by company performance, market conditions, and economic factors. Bonds, on the other hand, are like loans you give to governments or corporations. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. They typically offer lower returns than stocks, but are generally less risky. Bonds are considered safer because they provide regular interest income and are less susceptible to market volatility. Real estate includes residential and commercial properties. Investing in real estate means buying physical properties which can generate rental income and appreciate in value over time. It can provide rental income and potential appreciation, but can be illiquid. Unlike stocks and bonds, real estate cannot be quickly sold without potentially affecting its price. Commodities are raw materials like gold, oil, and agricultural products. Investing in commodities can be done through futures contracts, commodity-focused mutual funds, or buying physical goods. Their prices can fluctuate significantly based on supply and demand. Factors such as geopolitical events, natural disasters, and changes in production levels can cause commodity prices to rise or fall sharply. Cash equivalents are highly liquid investments like savings accounts and money market funds. These are short-term, low-risk investments that can be easily converted to cash. They offer stability but typically lower returns. Cash equivalents are ideal for preserving capital and providing liquidity, but they do not offer significant growth potential. By strategically allocating your money across these different asset classes, you create a diversified portfolio that balances risk and potential return according to your investment goals and risk tolerance. This approach helps you weather market fluctuations and achieve long-term financial stability. Diversification is not just about spreading your money around, it's about understanding how different assets interact and complement each other in your portfolio. Section 4. Variety is the spice of investing, diversifying within asset classes. This means not just spreading your investments across different asset classes like stocks, bonds, and real estate, but also diversifying within each of these categories to further mitigate risk and enhance potential returns. Diversification doesn't stop at simply owning different asset classes, it also means diversifying within those classes. This approach helps to ensure that your portfolio is well-rounded and resilient against market fluctuations. Think of it as adding different spices to your investment dish for a more flavorful and balanced result. Just as a variety of spices can enhance the taste of a meal, a mix of investments can improve the performance and stability of your portfolio. Within stocks, don't just buy tech stocks. Branch out to other sectors like healthcare, consumer goods, and energy. Each sector has its own set of opportunities and risks, and by investing across multiple sectors, you can capture growth from different parts of the economy. Consider investing in companies of different sizes, from large-cap giants to small-cap upstarts. Large-cap companies often provide stability and dividends, while small-cap companies can offer higher growth potential. Balancing both can give you a mix of security and growth. Within bonds, diversify by bond maturity date, short-term, intermediate-term, long-term, and credit quality, such as government and corporate bonds. Short-term bonds can provide liquidity, while long-term bonds can offer higher yields. Mixing different credit qualities can balance risk and return. Within real estate, explore different property types, such as residential, commercial, or REITs, real estate investment trusts. Residential properties can offer steady rental income, while commercial properties might provide higher returns. REITs allow you to invest in real estate without owning physical property. Consider geographical diversification as well. Investing in different regions can protect your portfolio from local economic downturns and give you exposure to global growth opportunities. Within commodities, spread your bets across different commodities like precious metals, energy, and agricultural products. Each commodity reacts differently to market conditions, and diversifying can help stabilize your returns. By diversifying within each asset class, you further minimize the impact of any single investment's performance on your overall portfolio. This layered approach to diversification can help you achieve a more consistent and reliable investment outcome. It's about not putting all your eggs in one basket, even within the same basket. By spreading your investments within each asset class, you create a safety net that can protect your portfolio from unexpected market shifts and enhance your long-term financial stability. Section 5. Beyond your backyard, the allure of international diversification. Don't limit yourself to your home turf. International diversification means investing in companies and markets outside your own country. This opens up a world of opportunities to tap into global growth and potentially enhance your returns. Emerging markets, for example, often offer higher growth potential than developed economies. By including international investments, you can benefit from the economic expansion of different regions. International diversification also helps reduce the impact of currency fluctuations on your portfolio. When the value of one currency declines, investments in other currencies can help offset the losses. Remember, investing in international markets does come with its own set of risks, such as political instability and currency fluctuations. However, the potential rewards of participating in global growth can often outweigh these risks. Section 6. Investing made easy: ETFs and mutual funds as your diversification allies. Building a diversified portfolio from scratch can seem daunting, especially for beginners. The sheer number of options and the complexity of financial markets can be overwhelming. That's where exchange-traded funds, ETFs, and mutual funds come in as your diversification allies. They simplify the process by pooling together a variety of assets into a single investment vehicle. ETFs and mutual funds are like baskets of investments that track specific indexes, sectors, or investment strategies. This means you don't have to pick individual stocks or bonds, the fund does it for you. By investing in a single ETF or mutual fund, you instantly gain exposure to a diversified portfolio of underlying assets. This diversification helps spread risk and can lead to more stable returns over time. For example, an S&P 500 index fund will invest in the 500 largest publicly traded U.S. companies, providing instant diversification across various sectors. This means your investment is spread across technology, healthcare, finance, and more. These investment vehicles offer a convenient and cost-effective way to achieve diversification, even with a small amount of capital. You don't need a large sum of money to start investing in ETFs or mutual funds. They are particularly useful for investors who lack the time or expertise to research and select individual stocks and bonds. With ETFs and mutual funds, you can leave the heavy lifting to professional fund managers. When choosing ETFs or mutual funds, carefully consider their expense ratios, annual fees, and their investment objectives to ensure they align with your overall investment strategy. Lower expense ratios mean more of your money is working for you. Additionally, look at the fund's historical performance, the reputation of the fund manager, and the specific assets it holds. This due diligence can help you make informed decisions and select the best funds for your needs. Consider setting up automatic investments into your chosen ETFs or mutual funds. This strategy, known as dollar cost averaging, can help you build your portfolio steadily over time, regardless of market fluctuations. In summary, ETFs and mutual funds are powerful tools for achieving diversification. They offer simplicity, cost-effectiveness, and professional management, making them ideal for both novice and experienced investors alike. By incorporating these investment vehicles into your strategy, you can build a robust and diversified portfolio that stands the test of time. Happy investing!